right, thank you, Amy, and good afternoon, good morning to everyone, depending on where you're joining us from. And thank you for taking the time to join us. What we want to do today is talk about strategies to grow your wealth in the context of financial planning. And so what we want to talk about is wealth growing strategies with a long-term focus, but also we want to contemplate some of the things that are happening in the marketplace today, and what are some things that you can do in the context of your financial plan to take advantage of some of the things that we're experiencing today. So as Amy said, there we go, get the slides going here. My name is Brad Kelly. I'm the principal in charge of Eide Bailly Financial Services. And joining me today is Kenny Dupree, one of our financial advisors located in our Minneapolis office. You know, as I was preparing for comments on this topic for today, I was thinking about really going back to my childhood. When I was a kid, I remember our family was going to take a family vacation, traveling from Minnesota down to Texas. And I was telling Kenny about this earlier, and he didn't know what I was talking about. In that, I remember my dad was preparing for our journey, and he went and bought a road atlas booklet. It was like an oversized magazine that had inside of it, and some of you maybe remember these, but you would have that, you would open it up, big magazine type document. You'd open it up, and on the left-hand side and right-hand side of the page together, it would show one state, and it would show, depending on which page you turn to, but it would show that state. It would show all of the highways and county roads and interstates and cities and towns of that state. And so it had all 50 states in this road atlas. So I remember my dad preparing for the journey and would turn to the page of Minnesota, kind of draw out the roads that we were going to take on our way down to Texas. And once he got to the end of Minnesota, he'd flip over to the Iowa map and then continue on mapping out the journey over to Nebraska, then down to Kansas, and then finally Oklahoma, and finally to Texas. And I remember him mapping this out, putting it together, but also thinking in terms of not just the roads we would take, but where would we stop along the way? Where would we stop to fill up with fuel, to purchase or get our food, for lodging, and kind of mapping that out and putting that game plan together. Now looking back now at that, you know, you can see the flaws in that atlas was only as good as the time it was printed. It didn't take into consideration any changes that had occurred since the time of publication. So any roads that have been opened, new roads or roads closed, or road construction, you just kind of had to deal with that as you were going through the journey, and you would have to change how you were navigating depending on what you came up on. And really, as you changed, you didn't really know what that meant to the end of the journey. Would we get there sooner? Would we be delayed? How delayed would we be? You just kind of had to deal with that in real time. You know, you fast forward to today, and I watch my kids now as they think about journeys. They're, of course, using technology to map that out, and using their technology along the way to really navigate in real time, to see what's ahead and making changes in real time to that journey, and knowing instantaneously what the results are of making those changes. You know, financial planning's been kind of the same evolution. When I started out in my career, we would meet with clients, we would gather data, go back to our computers, build out financial plans, and print basically a road atlas, come back to the client and lay out the journey to the client on achieving their goals and objectives. And that booklet that was created was really dated a month later, when things changed in the marketplace or things changed with the client. The plan had not considered that. It couldn't update in real time. And so that was somewhat of a drawback. Today, though, we have the technology that allows us to navigate in real time, just like if we're navigating a trip, we can navigate the financial plan. And not only can we keep an eye on the long term, but we also can look at short term. If we take advantage of things that are happening in the marketplace, what could that mean at the end result of our journey? So really within the context of that, I always ask the question when we're working with clients or we're building out strategies to build wealth, are we trading or are we investing? Because those are two different things. Trading is really more of thinking in terms of what's happening today and trying to leverage on that today to get real-time, instant rewards for that. Investing is a much longer time horizon. It's looking at the totality of the journey that we're going to be on, and it is deploying strategies to achieve the results that we want in the long term. So within that, we need to look at as investors, where are we at today and how does that relate to what's happened in the past? How might that impact us as we go forward? As you probably know, we've been in a very difficult market environment this year. We are in a bear market. And if you go back to the mid 60s, we've had 9 bear markets, counting this one that we're in. What this graph shows, there's a lot going on here, but the blue bar charts are showing bull markets that we've been in over that time period, the rate of return that we've received over that time, or the swing upward, if you will, and how long that bull market lasted. On the reverse side, kind of this brown reddish bar chart down below shows the bear markets, how often they've occurred, how deep they've been, and then how long they've lasted. And so if you see over here on the bottom right corner, this is the bear market we're currently in. We're down at the end of third quarter about 25%, depending on which index you're looking at. We're about 9 months into the bear market as well. And so you look at that and you think of that in terms of building wealth in your financial plan. You want to consider, all right, are we in environments we've been in before? And you can quickly see yes, very much so. And if we average these bear markets out and look at what they've shown us, it looks like typically the average bull market's about 70 months and the average bear market's about 14 months. The returns you can see are listed here. The bull markets are giving us about a 200% return on average. The bear markets, you can see from the high when the bear market started to the low, is on average about 37%. And so, of course, the whole point of this is where you're building wealth in the context of your financial plan. We're investing in capitalism, and we know that capitalism over the long term is going to generate a positive rate of return. This certainly bears that out. And you can see here that the bear market we're currently in is well within the range of bear markets that we've seen in the past. Now, we often ask, okay, well, what happens as we come out of a bear market? This is a slide going back to 1926 to the end of 2020, and it just shows the bottom part of this graph shows that if the market, on the left-hand side, if the market pulls back 10%, what tends to happen going forward? The middle part of the graph right here shows that if the market pulls back 20% from its high, what tends to happen? And then also the last part of this shows the market pulls back 30%, what tends to happen going forward once it hits the bottom. You can see in this case, in all 3 scenarios, the bounce back is pretty significant. You can see that you're up pretty significantly in the next 12 months once the correction has hit its bottom. And you can look at over the 3-year cumulative and 5-year cumulative what the returns have been on average. So what that means is that trying to time this is very difficult. And so it's important that in the context of building wealth and building your financial plan, that you're building strategies that allow you to kind of ride the course, if you will. This chart actually shows the importance of not trying to time the market, to not be emotional about the things that are going on in any moment in time and making emotional decisions. What this chart is showing is if we go back to 2002 to the end of 2021, it's showing that the S&P 500 has provided an average annual rate of return of 9.5% over that period of time. If over that 20-year period, you missed out on the top 10 trading days over that period of time, you actually cut your return in half. Your annualized rate of return was cut in half. You can see if you were out 20 days what it did, and then all the way out to 30 days. My point here is that, again, as you're building wealth over time, you don't want to make decisions that will jeopardize what you're trying to grow over time. So trying to time the market is very difficult, which is much different than making tactical changes to your portfolio at different points in time. That's completely different than trying to time the market. And we're going to talk about that here in a bit. So this kind of reminds me, one of the individuals that academics that we work from, his research in the University of Chicago. This is a great quote that kind of just highlights what we're just talking about, in that money is like soap. The more we handle it, the less we will have. And so again, we want to be very careful with how we're handling our wealth, accumulating and growing our wealth, and not to make decisions that will jeopardize that in the future. So let's talk a little bit about what is happening right now and how does that fit in the context of history. As you know, we're dealing in a very high inflationary environment. So as we went through COVID over the last few years, we had a lot of liquidity that was put into the market through a number of different means. And so what happened was it drove up demand for goods and services. People had extra money in their pockets. They went to spend it to update their homes, to do things in their backyards, to travel, to do different things. And so we've had now the demand that has put stress on the supply chain. And as a result of that, it's driven inflation up. And so to give you a little bit of context, here's where we're at from an inflationary standpoint. You know, we're up in about 8% inflation. And so we've just had readings last week, actually, that showed that, you know, the economy's still pretty hot, although we might be seeing signs that we're maybe topping out from an inflationary standpoint. We'll see how the rest of the year plays out. But the last time we saw inflation like this was over 40 years ago. It was back in the 70s and early 80s, where we saw high inflation. We've had a 40-year period where we haven't had inflation, and so to the levels that we're seeing now. And so in the context of building wealth and building within your financial plan, we've not had to consider high inflation before like we've had to recently. But that gives you a sense of where we're at today in context to where we were back in the 80s and even prior. What's happened with the markets and why they've been behaving the way they have been is that you probably have heard this, but you know, the inflation now has crept into the economy. The Fed probably waited a little bit too long to try to jump in and deal with this. And so they sat on the sidelines, and once the economy got pretty hot, they had to jump in and start raising rates. And as you know, they've been raising rates very aggressively this year. And actually, if you compare that back to the 1980s, the last time we had high inflation, we get a little context of the rapid rate of increase that we're seeing here and how it's compared since the 80s. There's been a number of times where the Fed has been raising rates over the course of the last 40 years. What this is showing is the rate of increase on this side of the chart, and this is showing the number of months until the Fed stopped raising rates. So you get a little bit of context here. You can see the years that they've raised rates when they stopped. This blue line is the current rate cycle that we're in right now. And you can see that they've raised rates by 3% up to the Fed funds rates 3.25%, but they've raised by 3% over a 6-month period. as opposed to the 80s, the last time we were in a high inflationary environment. They raised a little over the same percentage, but they did it over a 15-month period. They would raise, kind of let it work through its cycle a little bit, raise again, let it work through the cycle, and then raise again. So we're seeing the Fed raise at just a rate we have not seen since the 80s and even beyond. So what's happened is it's created tremendous volatility in the bond market this year. And one thing that's happened this year that we've never seen before is that we've seen both bonds and stocks down in the same year by double digits. Bond markets are down, depending on what you're looking at, 12 to 15%. Equities are down 20, 25, maybe even a little bit more. So we're seeing something that really has never happened before, but this is the reason why that has occurred. Now, what it has done is it's created some opportunities with cash positions and short-term bond positions that we'll talk about here in a bit. All right, so this is something that in all of our presentations we will show just to put a little context around the idea. If you go back to my analogy at the beginning of taking a journey and driving from Minnesota to Texas, the vehicle that you're taking to get there is really, in terms of our analogy, is our investment portfolio. Our investment portfolio is what drives us down the journey of our financial plan. And so how do you best deploy your portfolio, your vehicle, to allow you to achieve your long-term goal? The best way to do that is to diversify your investment portfolio. What this is showing, and kind of proves this out, is that this graph actually shows, or this chart shows, each column is a year, going back to 2012 up to 2021. And what it's showing is the best performing asset classes ranked best performing down to the worst performing in that particular year. So what you're able to see here is that oftentimes the best performing asset classes over a couple year period will probably end up toward the bottom the years following. That's just market volatility that you tend to see in the market, whether it's stocks or bonds. The best way to approach this is to own all of the colors. And if you own this white box, shows a diversified portfolio, kind of shows plodding along through year by year, really not having high highs or low lows, just kind of working its way through and generating a solid average return over time, a solid return that fits nicely into a financial plan and really gives you the best chance of achieving your desired outcome at the end of the journey. You can take other roads in getting there, but by doing that, the road's going to be probably bumpy. You're probably going to get off the interstate. If you think of a diversified portfolio, it's probably the interstate, the best maintained roads, if you will. There might be routes getting you there faster, but you're going to have to get off the interstate. Those roads may not be as well maintained. It might get you there faster, but it's going to be a bumpier ride to get there if we just concentrate on one or two of these colors. And so that's kind of the concept of broad diversification in the context of building wealth over the long term. Okay, so before I turn this over to Kenny, just thinking about as we're building the wealth and doing it within a financial plan, you must consider really all four of these components in building a plan and thinking about managing wealth. The first one is the top left corner, which is cash flow planning. Absolutely critical. We have to know the journey that we're going on, what our cash flow needs are going to be, both immediate, intermediate, and long term. So what will I need to fund my standard of living, college expenses for my kids or grandkids, retirement living, investment opportunities that may come up, and then ultimately any gifting and charitable planning that I want to do. What's going to be required to fund those goals that I have? We have to define that and understand what those needs are going to be. We also have to understand, what if we don't make it to the end of our journey? We've mapped this out. We're going from Minnesota to Texas, but what if something happens along the way that we don't get there? And that's where insurance planning comes into play and will backstop any any events that occur in the context of the plan that we need to backfill with insurance needs. The bottom right corner is the estate plan. At some point, I've reached the end of my journey and I need to turn the car over to the next generation. We're going to have new drivers that are going to be stepping in, continuing the journey. The estate plan really covers that piece of it. And then, as I said before, the investment portfolio is the vehicle. That is the engine and the vehicle that gets us to our destination that we're trying to get to. You can't look at any of these in a silo. You have to consider all four of these when you're really thinking about building, accumulating your wealth, and really mapping out your financial plan. So that's kind of the long-term thought. In the short term, before I turn it over to Kenny, we're going to talk more about this, is that we always want to think in terms of, all right, what's happening today? What can I do? Not market timing, but what are some tactical things that I can do in the context of building wealth in my financial plan that I can take advantage of the current environment today. We're going to talk more about this toward the end of our session and talk a little bit about what we're doing with clients today in these areas. So with that, before we get to that, I'm going to turn it over to Kenny, and he's going to walk through the technology that I was talking about earlier that allows us to map this out in real time. Kenny, I'll turn it over to you.
All right. Thank you, Brad. I'll go ahead and flip my screen on here. What we're looking at here, guys, is a fictitious client in the financial planning software that we use. And just for a little bit of context here, we're looking at a client that's in their mid-50s. They own a small service business, and their primary goal at this point is looking to retire. So kind of like how Brad laid out this analogy that this road trip from Minnesota to Texas is retirement. And if we think of the vehicle that's going to take us there, that's ultimately your investment portfolio and your net worth statement. So what I'm starting on here is a net worth statement. And I think it's very typical for people to put one of these together. But I was hoping today to just highlight what a financial advisor is paying attention to when we look at a net worth statement and some of the opportunities today in this unique environment that might be out there. So to start out, we have this categorized really nicely. So right off the bat, the first category here is cash and cash alternatives. So, for most people, it's just looking at what they have in their bank. So financial planning 101, the number one priority for folks is establishing what we call an emergency fund or a rainy day fund. And as far as the standard for how big that should be, in general, if there's a 2-income household, that's anywhere from 3 to 6 months of living expenses. And if it's just a 1-income household, it might be 6 to 9 months worth of living expenses. So, hopefully nothing too wild there, but it's just kind of saying, hey, there's a bucket of money there where we don't have to sell anything at a bad time in order to gather some funds to cover something that might be unexpected. So right now in the current environment, there are some really good options out there for short-term savings that weren't out there, 9 to 10 months ago. So, right off the bat, I'll just kind of list off some of the options that are in front of you. So very popular with some of our clients has been with excess cash to put in what's called a money market fund, which is by nature a mutual fund, must be owned in a brokerage account, but it's about as safe as an investment as you can find out there. Under the hood of that is essentially just some ultra short-term corporate bonds. But I know Schwab has some money markets that are paying about 3% right now. Over and above that, you could look at potentially a 6-month CD, which is paying 3.5% to 4%. And even the 2-year treasury right now is between 4 and 4.5%. So there are options right now available for this sort of excess cash emergency fund idea that weren't there for investors even at the beginning of the year here. Now within that, my final note on that is that there is what they call a cost of liquidity. So, even, that 2-year treasury sounds like a great idea to get, maybe close to 4.5% right now. But your money's going to be tied up a little bit longer. And, the best example is probably those CD rates, which are pretty attractive. They're quite a bit higher than a money market fund, but you're going to pay some sort of penalty and lose out on that interest if you try to access that within the term before that fully matures. So beyond cash, and Brad, if you just keep an eye on the questions, if they come in, go ahead and interrupt me. Beyond cash is this next bucket here. We call it taxable investments, but essentially that's just, think of your just everyday brokerage account. The important things to note here, and this is a financial advisor looking at a net worth statement. The first is that it's not, the opposite of this would be a qualified retirement plan. And within those, they have a lot of tax advantages. But for those tax advantages, there's a lot of strings attached. So if we just kind of went and opened an individual account, the first thing is that there's no penalty at any point to withdraw this money. And then the second would be, from a tax standpoint, your tax at capital gains rates. So this is kind of, once you have that emergency fund settled and your cash position looks healthy, you have some excess right now, given the pullback that we're going through. Great place to put it is this taxable investment account. So from a management standpoint, a couple opportunities that we're in front of, right now. S&P 500 year to date is down probably just under about 25% as of this morning. So with that, there's a strategy out there called tax loss harvesting that would be an opportune time to execute right now. And what that is essentially, if you're someone who has outside gains, maybe from a real estate transaction or a business transaction, or simply moves you made in another investment account, you could potentially offset that by selling something at a loss in your taxable account. Within that, it also offers an opportunity to reallocate how that is invested. So we'll see a lot of folks with, the most popular one is that they'll have some sort of stock option plan through their employer, and they'll be very concentrated in one holding. And it's sort of the, good news, bad news of, hey, your account's down quite a bit, but now we have an opportunity to actually do something with that account, and we can change the way that we're managing that. So I really like what this report does right here, is it kind of totals your, what they call non-qualified assets. So we get a little bit of a subtotal. And why this number is important is that everything above this line, you can access penalty free. So this is either your really short-term goals or your intermediate term goals, where these are funds that you can get at, especially that taxable account, if you have aspirations for, potentially a home improvement or, some sort of celebration like a wedding or potentially second property, between now and ultimately right around age 60, that's going to be the best vehicle to help get you there. If we keep going down below this, we're going to see retirement assets. And for the majority of folks who are, gearing up and thinking about retirement, the vast majority of their wealth is going to be in a 401k account through their employer plan is kind of the most convenient place to save. So that's very typical what we see. So I'm going to try to, put yourself in the mindset of you're about to take this trip that is retirement, and you kind of have to start just by pulling out of the driveway. And by doing that, you make a very distinct change in your mentality from this accumulation mindset to a withdrawal mindset. And I think we work with a lot of people who are just kind of keeping their head down working. And it's just good to remind them, hey, at some point, we're going to switch from saving like you have been, and we're going to need to game plan how to withdraw out of these accounts. So at a very high level, there's two basic flavors of a retirement plan. Kind of see the traditional dollars up here, and then below that would be a Roth IRA. So like I said earlier, for the majority of people, you'll see the bulk of their wealth sitting in a 401k plan. The important thing to note there is once you do pull out of the driveway and you enter this journey of retirement, every dollar you take out of that plan is going to be ordinary income taxable. So although it's awesome while we're working to just save in there and get that tax deferment, it does take maybe a little bit of planning on the back end when you do go into withdrawal mode, just knowing that every dollar you take out is going to be ordinary income taxable. So for example, if a client calls us and says, hey, I think I need, 40,000, I have a wedding coming up that I want to help with, most likely we're going to withdraw, maybe 55,000, have to withhold some for tax to get that 40,000 to them. The second flavor of this is a Roth IRA, and there's a couple benefits that I want to highlight right now about a Roth IRA. So the first is that those traditional accounts, because you were able to save in those tax-free, Uncle Sam comes knocking at right now what is age 72 for what's called required minimum distributions. And so that is, all based on a formula of a table set up by the IRS, telling you exactly at a minimum how much you have to start taking out of those accounts. Roth IRAs conversely do not have that feature. And when you invest in those, you actually pay tax on the income up front and then never have to pay tax on it again. So, that kind of leads to this strategy that we're employing more and more, and is especially potent when we do have a market pullback, and that's a strategy called a Roth conversion. So what you are able to do is take some traditional dollars, if you own them in an IRA, they can't be in a 401k, must be an IRA, and convert a portion of those dollars to a Roth IRA. A couple reasons that you might want to do that. A, you're going to avoid being put on that required minimum distribution schedule set up by the IRS. And two, you're never going to pay tax on those dollars again. Not only you, but also your heirs. And as a real quick note, eventually when you do get down to, thinking about legacy and what your estate looks like, if you pass away and you still have IRA dollars or 401k dollars out there, right now the law states that your heirs would have to withdraw that within 10 years at their own tax rates. So it's kind of, again, Uncle Sam's way of making sure he does eventually get that tax income. So for the Roth conversion, a couple things to think about. They are most potent when you're in a low income tax year. So if you kind of think about, where potentially the federal income tax brackets are, we usually play a little bit of a tax bracket game saying, hey, we know for a married couple filing a joint tax return, if they have less than $83,000 of income, then they're at the 12% marginal federal income tax rate. So if there's a year where maybe a client is, halfway retired, they're earning a little bit of part-time income, maybe 40,000 of income, we'll want to take 40,000 from their IRA, convert it to a Roth at a very low income tax bracket, and realize a little bit of that tax while we can at a low rates to never have to pay tax on it again.
And Kenny, just a quick question that came in to maybe clarify. So you did mention it has to be done from an IRA account, traditional IRA account. The question is, can you take dollars that you've rolled from a company plan, from a sponsored plan into an IRA? Can those dollars be converted to a Roth?
Absolutely, yep. So that's kind of a two-step process there. So the first would be what's called an IRA rollover. And what an IRA stands for is individual retirement account. So, again, most of you are probably just saving through your employer, most traditionally in a 401k. When you leave that employer, so when employment has ended, you have the option of leaving those dollars there or rolling that out into an individual retirement account. And once it's in an IRA, you have that flexibility of executing the conversion. Brad, I saw another question in there that was kind of, asking about what's the time horizon difference between thinking of trading or investing. And, as I look at this, if I look at this net worth statement here, we kind of go in order of time horizon, the different parts of this. So, cash needs, that's going to be anything, in 6 to 18 months, maybe that's right in front of us. The next step would kind of be those intermediate term goals of, hoping to invest in a taxable account, and those goals might be 5 to 10 years down the road. And then we look at our retirement accounts, which have specific provisions, those strings attached, that there's a penalty to withdraw those dollars before age 60. So I don't think necessarily the trading versus investing mindset is more so time horizon driven. I think, even on the short term end of things, we want to make sure that we're buying the right things that make sense in the context of the plan. We will have some clients who just say, hey, I love just picking a stock here or there, and we kind of call those play accounts. And if you want to throw a little bit of money in a play account, most of the time that's fine, as long as in the greater scheme of things, a long-term outrun, that the majority of assets are working towards those bigger goals. Okay, so just to kind of round out the net worth statement here, this is the other important line here. If we look at total liquid assets, so it's a very important division in a net worth statement, if you make your own, noting what portion of this is liquid. So everything below this line essentially is going to be in business assets, real estate, or personal property. And while a lot of people have successfully grown their net worth through real estate, it's important to make that distinction that it is not liquid. And the vast majority of the clients that we see, it is this liquid portion, their portfolio assets, that are the engine for them to help propel them through retirement. So, right now as it sits, again, this fictitious client here, north of 2.25 million in liquid assets, and then total net worth is going to be about 5 million. So I think I mentioned this at the start. A big part of this particular client's plan is that they are a business owner, and that would be a challenge for them to navigate upon retirement.
Yeah, and Kenny, I would just add to that. I mean, when we get to the illiquid section of the net worth statement, you have to distinguish between lifestyle assets and income producing assets. So, the portfolio can kind of spill down into here. We can have assets that are illiquid but generating income, right? And that can be a big part of the strategy going forward. That's different than a lifestyle illiquid asset, which would be a second home, a beach home. That's for lifestyle enjoyment. So you got to kind of work through both of those, both of those channels as you're working through this and understanding how it fits into the plan.
Absolutely. So, to Brad's initial analogy here of kind of how things have changed for us, within this particular software, we're able to link in all the accounts, whether they're held with us or held outside. And what a link does is essentially just every 24 hours, we get an updated value. So it's kind of like that, when you put Google Maps in to take you somewhere, it's constantly recalibrating, kind of saying, hey, there might be a better route, or changing your estimated time of arrival. And that's kind of how we found, things really need to be done nowadays. Okay, the second report I'll show before I kind of move to some of the better visuals of the output side of this is a cash flow report. So, if you kind of ask me as a financial planner, what are the two most important things you look at? It's really diving into a net worth statement and getting to understand it. And the second part would be doing some sort of cash flow analysis. So, I pull this up here. At the end of the day, it's a glorified spreadsheet, but the goal is to track for a household the expected inflows and outflows for a client. So if I just pop into a couple of these columns at a very high level, I'll open income flows here, and we start to see both the dollar amounts and the timing of some important years for the client. So, we kind of see the years running down the side here, with both spouses working for a while, ultimately hitting this retirement date. Base scenario has that at age 65. and then noting the switch to there's a pension out there and some Social Security income. So it starts to help us visualize, what do the next 20 years look like from a cash flow standpoint. And then conversely, on the other side of this, I go back to my main screen here, we kind of see right in the middle total inflows, just kind of adding up that column that we were just in. On the other side of this, we'll get total outflows. So, when in your working years at a high level, there's really two basic things that you can do: either save those dollars or spend them in some capacity. And within that total expense number is an estimation of taxes paid. Ultimately, we kind of want to get an idea of what that pressure looks like. So I'm going to actually fast forward here to the retirement years. So, once they both called it quits, at this point, there's a pension and 2 Social Securities coming in. The door is income, but we still have all these expenses here. So, if I pick on, 2034, there's 110,000 of income, but about 350 of expenditure needs. So with that creates a deficit. And what that deficit ultimately means is that there's some withdrawal pressure on those assets, which leads us to our final column here, total portfolio assets. So starting on that net worth statement, I made that specific distinction to say, hey, of their about 5 million of net worth, what portion is actually liquid today in portfolio assets? We saw that was just above 2.25 million. And what we're interested to track and try to forecast as financial planners is where does this head over time? So you kind of see, obviously while they're working and they're saving and they're not withdrawing, the expectation is that that bucket would grow. But what about at retirement? We do start seeing those withdrawals come out, and there's a little bit more pressure on the portfolio. How does it stand up? The last thing I'll say here on this report, if there's one column I want to come back to, and that's planned distributions. And so again, this was kind of for those traditional dollars in there, 401ks and IRAs. There's a law right now at age 72, you're subject to those required minimum distributions. So another important concept when doing some cash flow planning. Okay, I'll move it to some nice visuals here. All right, so what we're looking at right now is taking that cash flow report that we were just looking at and essentially just graphing it over time. So if I hover over this first bar, we're going to see that same number, about 2.3 million in portfolio assets. You see that continue to accumulate while this couple is working. And then this little button down here is going to note a retirement date. And so this is ultimately what we want to analyze as what does their life look like after that retirement date. So this is kind of what we call the base case scenario. And like Brad said with that atlas analogy is, that's sometimes only as good as a snapshot in time. So really the process of going through this type of exercise is to use this as a decision-making tool. And so what I have up here is I've just populated a couple different toggles that we can play around with this ultimately to help make some of those big life decisions. So, I'm going to start with these bottom ones here, which I really like. So we have a business owner here contemplating what a sale would look like. And so, I'll turn this first one on here, which we see all the time, is someone coming to us saying, hey, I just got an offer for 800,000. I really think the business is worth more than that, but I just want to know what it would look like. And so here you see that business sale at age 60 and the benefit of doing that. And then I can go all the way down here to the bottom one, which says, hey, maybe I work another 5 years, the business is able to sell for a lot more. And what if I decide to do that in some form of installment sale? So if I flip that on, give it just a second to wake up, you see how much healthier that looks. So, from there, you might come back to the drawing board and say, okay, if I go that route, What if I want to do a little bit of additional travel? Does it allow me to do that? So now we're kind of compounding these on top of each other, and then kind of say, hey, you know, that country club I've always wanted to join, what if I go ahead and do that as well in retirement? So, you know, these could be anything that you dream up. It could be, you know, I want to gift to my children. I have charitable goals. I'd like to buy a second property. There's that home improvement, you know, I've always been dreaming of. Just about anything you dream up, we should have the capacity to model. And then the second part that I'll show you here, I think is very, very important for the last 10 months that we've just had here, is doing what's called a Monte Carlo analysis. So what this does, once I let it load up here, is it runs 1,000 trials of differentiating market returns based on some of the volatility that we've seen in the markets past. So ultimately, this is sort of trying to test a different sequence of returns. So if we're assuming on average maybe a 6% rate of return in a portfolio for a planning sake, you know, it just doesn't go 6% every year. Within that year to year, there would be significant volatility. So this dark blue line in the middle ultimately was what we were seeing on the last graph, but we get some sort of spread here. So I'll just pick on year 2040. So it kind of said, you know, the average trial of these 1,000 was, you know, about 5.7 million, but the 80th percentile was close to 8, and the 20th percentile was close to 4. And you know, this is really an important part of doing some of this forecasting, because there's so many unknowns out there. And the two that are right in front of us right now are investment returns and inflation assumptions. So you kind of have to have ways of trying to plan for that a little bit, accepting that, you know, part of this is just simply unknown. Brad, I think that's probably about all I had to run through on the plan here. If there are other questions or
We do, and maybe Amy, we could go back to our slides and go back to the opportunities slide that we left on. Yeah. So yeah, thanks, Kenny, for taking us through that. There was one question on your modeling. You were showing the required distributions that have to come out of a qualified account. I think there's asking for clarification on that. That is age 72. And talk again about the Roth, the benefit of the Roth related to RMDs.
Yep. So those required distributions, again, there's the IRS publishes a table that is very specific about what percentage of the account has to be withdrawn every year. So what they do is they look at the December 31st balance of the prior year. They divide that by what they call an RMD factor. And once you get to that age, it's going to be very clear what the minimum amount that you have to push out of that account is. One way to try to plan around that is to execute Roth conversions. Typically, the years most effective to do those are going to be between retirement and Social Security drawing age. So typically there's, you know, maybe there's 5 or 6 years in the middle there where earned income is low. And in a low income year, when you convert from traditional dollars to Roth dollars, you do pay ordinary income tax on every dollar that you convert. But if you can do that while you're in a low income tax bracket and get it over to a Roth IRA, you'll never pay tax on it again. There's no requirement of when you have to take the money out. And ultimately, if that does become inheritance, your heirs won't have to pay tax on that as well. So extremely effective tax management strategy, and something we're trying to look at with almost all of our clients.
And, you know, I would just add to that, because you made a comment about how that's calculated. So for this year's requirements, right, they're based on December 31's balances, and the market was much higher than it is today. So the idea of, you know, managing, we were talking about accumulating wealth here. Now we're talking about wealth distribution, you know. So if you're working off of a higher balance to make that calculation, your portfolio has suffered some downside here, and we're having to take money out while the portfolio's down, pay tax as well. We've really have kind of compounded the impact of that distribution. So planning for that R&D and having dollars set aside or within the portfolio to contemplate market volatility is very, very important. So Kenny, some other things that we're doing right now, just in the midst of the market environment we're in, you can see here on the screen, we're talking to clients about looking at gifting. If you have portfolios now that are down pretty significantly, or assets that are down in value as a result of the environment we're in, now might be a good time to consider making a gift to your heirs, as an example, and get those assets over to the next generation. So when the recovery does happen, it's happening in their bucket as opposed to yours. So from an estate planning perspective, we are talking about gifting strategies right now from that standpoint. Short-term treasuries, Kenny, you touched on this as well, but we're finding clients that have been sitting in cash or maybe had a portion of their portfolio in cash. They're now, it's one thing to look at the damage of the equity bond markets from, looking at unrealized gains or losses right now, the impact on the portfolio from that standpoint. But the other side of the coin is that incomes now are generating, our portfolios now are generating more income. And so it kind of helps maybe shorten that gap or decrease that gap between what I've lost in value, I'm making up in more income right now. And so, as you mentioned, money market accounts generating 3%, short-term treasuries, 4.5%. So there's certainly some opportunities to tactically redeploy, if you will, and take advantage of some higher yields that are out in the marketplace. Roth conversion, you've talked about a bit. Rebalancing is another item we're talking to clients about right now. And when I say rebalance, that doesn't necessarily mean that you're rebalancing back to your original allocation. It might mean that, hey, let's rebalance right now and tax loss harvest, but let's introduce some asset classes maybe we didn't have before. I know that municipal bonds have really kind of been off the table for the last several years. They're coming back into play again. And then there's some opportunity in the municipal bond market, depending on where you're looking, but there's opportunity right now to bring municipals back into the portfolio and generate some really nice tax-free income, and provide some return that way as well. Kenny, anything to add to that from what you're seeing?
No, I don't think so. We have had a couple more quick questions come in. So some 401ks do have Roth provisions within them where you can either save on the traditional side or the Roth side within a 401k. And there's a specific question about this. I'm glad it was brought up. So if you leave those funds in a 401k, whether they're on the traditional side or the Roth side, both sides of that do have required distributions. It's only if you roll that out into, so you when you do a rollover, you would actually end up with two accounts instead of one. So you'd have an IRA in your name and a Roth IRA in your name. And at that point, the Roth would avoid those required distributions, but your IRA would still be subject to them. So if you leave the funds in a 401k, whether they're traditional or Roth, you would be subject to those.
One thing that we just wanted to end the call with today, and we've done this now for the last couple of years, but we've through our relationship with Charles Schwab, access to individuals within Schwab that can come and speak to us. And so Jeffrey Kleintop, who we've had for the last couple of years, will be speaking to us on November 11th. You can see at 12 p.m. Central Time. I'm sorry, November 9th from 11 to 12 Central Time. And so I encourage you to sign up for that. He's always provides great information, and it gives us great context around what's happened and what we might expect as we head into the new year. And if you notice the date there, it's going to be coming right off of the midterm elections as well. So he might have comments fresh off of the results of the elections and the impact that that might have as well in the markets going forward. So I encourage you to sign up for that. It's always good information, and join us for that. Somebody asked if that was 11 to 12 p.m. Oh, it said p.m. Yeah, I'm not sure what the question was, but yes. So 11 a.m. to 12 noon p.m. Right, Amy? Is that the right way to
12
say
noon
it?
Central Time. Yep.
Yeah.
All right,
Okay,
guys.
sounds good. Thank you for joining us, and have a great day, great rest of the week.